I'm joined now live from Sydney by Colin Whitehead. He's equity strategist at Fat Profits. Well, welcome to you, Colin. This looks like a very strong set of numbers indeed from Qantas. What do you make of them?
Well, look, it's obviously, as you say, a very strong set of numbers, but let's not forget it's coming off a very low base. So in that light, it's perhaps not quite as impressive as it may otherwise be. The market's reacted very well to the result. The stock's up today. But overall, from our perspective, we do still have concerns. We think that although management are highlighting the potential for improved yields through the course, or certainly through the next half and through the course of 2011, we do see headwinds there in as much as the capacity, the domestic capacity within the Australian airline industry has increased. Qantas has increased their capacity, but also competitors have as well. So that leaves the market in a more difficult position to pass through cost increases to their customer base. And we see higher fuel charges as a very firm headwind for the airline industry globally. And we suspect that Qantas may have to absorb some of those additional costs, certainly in the next 6 months. And so that would take the gloss off their performance through that period.
Now, you mentioned their capacity and Qantas is keen to expand. I was surprised to see that it only has 20% of the market share flights going in and out of Australia.
Well, they have more than that, split between their Jetstar and Qantas banners, of course. The Jetstar banner is the low-budget arm of Qantas, and it's growing very rapidly. And in fact, they're really transitioning into the low-cost model almost by stealth. And so I would expect to see further growth through Jetstar over the years ahead. And certainly that 20% figure, it wouldn't be anything to be of concern.
What about the stock price? I mean, we've just reported that it's been down over the last year by about 20%. Do you see some upside in it this year?
We take a fairly bearish view of the airline industry in general. It's a very capital-intensive industry. There are a lot of very cost-intensive variables that are beyond management's control that come out of the blue with concerning regularity. So overall, we wouldn't really be particularly keen on the industry in general. Qantas specifically has its own problems. Its brand hasn't suffered significantly, but there must have been some brand damage to the on the back of the number of incidents that they have suffered. Yeah. The Rolls-Royce engine issue is but one, but certainly that is an issue for them in this market.
Colin, let's move on. ASX was also out with figures today, but nobody's really paying attention to that. They want to know if the Australians are going to allow this deal with the Singapore Exchange to go through.
Well, that's absolutely right. Now, arguably, the stock is undervalued if one assumes that that deal does proceed, but there are fairly significant hurdles to overcome, and of course the regulatory approval is the primary one. Also, the law needs to change in terms of foreign ownership, which is currently capped at 15%. Now, the ASX is viewed, and certainly is, a national asset, an important asset, and therefore from that perspective the regulator would probably like to err on the side of caution and not allow it to fall into foreign hands. But that said, we are seeing a trend towards consolidation within the stock exchange industry globally. There are other examples, and this has been something that's been in place for a number of years. So I think the Singapore Exchange and the Australian Exchange should be able to make a fairly good case to the regulators that blocking this merger would in fact impede and devalue that national asset over the long term, because the individual exchanges would simply be less competitive and ultimately become less relevant on the global stage.
Colin Whitehead, thank you very much.